Hello, this is Mike Swanson. You're listening to the Wall Street Window podcast. In a few moments, I'm going to interview a very special guest today. I'm going to speak with Chris Vermeulen, who runs the website, thetechnicaltraders.com, get his take on what's happening in the financial markets at this moment. I think we're at a very fascinating juncture this week. But before I want to talk with him, I want to mention to you that over the past couple weeks, many of the major online brokers in the United States have announced that they're eliminating their trading commissions. Ameritrade did this a couple weeks ago, and then E-Trade followed suit. Charles Schwab did it. And this morning, as I'm doing this podcast, Fidelity made this announcement. And this is good news for traders, no doubt about it. I want to give you one thought I got about this. And really in the past 10 years, there's been a mania, if you want to call it that, in trading exchange-traded funds. It's so easy to press a button and buy one of these funds that hold a lot of stocks in them. For instance, the SPY fund holds 500 stocks to represent the S&P 500. But there's also sector exchange-traded funds that people trade. And I think this announcement of zero trading commissions should change the way we view these funds because they're not as diversified as people think, and they may not have big benefits to them anymore. So, for example, if you buy an exchange-traded fund, you've got to, as an investment, trading, in and out's one thing. But if you are planning on holding one of these things for a couple years, all of them charge a management fee of some sort or another, and all of them end up paying out less in dividends than you would get if you simply bought the stocks outright. So I made the argument in the past that if you actually have a large amount of money, of let's say several $100,000, and you are probably better off, if you want to invest in a sector, to buy the individual stocks inside the sector instead of one of these funds, because then you'll escape the management fees and you'll get more in dividends. The drawback, though, is if you have a small amount of money, let's say you want to invest $20,000 into a sector, then buying 10 stocks, those trading commissions would probably end up being more than what you'll get charged as a management fee from the ETFs. So ETFs are better. But with this announcement of the elimination of trading fees, I think going forward, it's probably best for just about everybody to buy individual stocks. If they want to invest in a specific sector, then buy one of these sector ETFs. I'll just give you one example before we speak with Chris Vermeulen, and that's the Financial Sector Spider ETF, XLF, one of the most popular ETFs out there. Now, it charges a 0.13% management fee and pays a dividend yield of 2.01%. Subtract the management fee from the dividend, you're speaking about, let's say, a 1.79% dividend. Well, when you turn and look at the actual ETF itself, 55% of it is simply in 10 stocks. And out of that 55%, almost all of this is really in 6 stocks. And if you look at the second, 11% of the fund is in JP Morgan, which pays a 3% dividend. Wells Fargo is another one. Almost all these stocks are paying a bigger dividend than 2%. So this XLF ETF is really concentrated anyway in 5 stocks, all of which are paying, for the most part, a bigger dividend than the ETF itself. So to make a long story short, if I wanted to invest in the banking sector, I believe I'd be better off just picking out 5 or 10 stocks, paying nice dividends, instead of buying the XLF ETF. Even if I just had $10,000, put $1,000 into 10 stocks, and the trading commissions no longer matter. So something to think about. you may want to consider when it comes to your investing and your trading going forward. So now let's speak with Chris Vermeulen.
Well, hello, Chris. How you doing?
Hey, Mike, I'm doing great.
Yeah, and I should tell people before I start talking with you, if they want to find your information, to go to thetechnicaltraders.com. And I also reprint some of your articles on my website almost every single trading day. So it's great to talk with you. And I'm curious to see what you think is happening in these markets because, we saw the market get a little squirrely in August, come back up in September, and now we're like on pins and needles for what's going to happen to this trade situation.
Yeah, well, the markets have been pretty interesting. I mean, August was pretty exciting with the wild price action, and then we got that nice rally out of there early September, and now we've fallen right back down into the similar type of price action as we saw in August. Big rotation, so huge sell-offs followed by big rallies, and it's pretty much happening like every other day. We're seeing a huge move, and we're stuck in this range. And long term, I'm bearish on the equities markets, but as a short term trader, I mean, I'm neutral, and I'm waiting to see which way this market is going to break. And the reality is, we are still in a bull market, so I wouldn't be surprised if this does resolve to the upside, like we've seen almost after every correction like this over the last 10 years. So I wouldn't be surprised if we see the markets try and push higher. But overall, you got to be really hesitant here because we are on the cusp, I think, of a huge market correction that could bring us back down to those December lows. And that's what I'm just, it's like walking on glass right now of what to do, what position to be ready to jump in if the markets start to break down. Do you short the market or get long bonds or get into precious metals? And that's the big question. So yeah, right now I'm neutral, waiting to see where things are going to break with all this news and Trump and tariffs, and there's all kinds of stuff lurking out there that could spark a big move.
Yeah, we're sitting right on the 200-day moving average or close to it. So, in August, well, we bounced off of it 3 times this year. So will it happen again? I guess we'll find out the next couple
Yeah.
sessions, I suppose. But well, what's your take on the gold market? Because we've seen gold go through 1350 a couple months ago, went up to 1550 in September, and it's been pulling back since then. There's some people calling for a big drop for the continuing throughout the rest of the year into New Year's, and others, think it's just going to pause and turn higher.
Yeah, I like gold. I mean, I've always been a fan more so of owning having physical metal. Maybe you don't have to hold it in your hand so much, but I mean owning like GLD type of play, and simply because to me it's the true global safe haven play. And a lot of people overseas aren't going to go buy GDX and GDXJ, but they're comfortable buying bullion gold because it's something that can be bought in any country, and it's not on an exchange or anything like that. And you look at gold, and gold broke out this year. It broke above that 2016 kind of high that we saw put in the market, and gold is truly in a new bull market. And that goes to show that money is moving to that sector. It's the hot sector. And if you were to pull GDX or GDXJ up, or even silver for that matter, in the same time frame, they have not broken out yet. And typically you see gold miners actually really lead the way. So it's really interesting to me that the fact that gold is leading the march and breaking out and extending here is telling me that globally there is huge problems and major concern among investors and individuals, and they're buying up physical gold because that is to them the true safe haven. Silver will be a late bloomer. It usually always is. It seems to be kind of the lagging precious metal, but it will play catch up. And so that's where I am. I'm a big fan that gold is kind of the global play. I mean, gold miners are highly leveraged, so you can make a lot more. But in terms of the slow grind and move higher, I think gold is more supported than miners in terms of a sell-off happening.
Well, it's kind of the timing of doing the interview is kind of funny because I do think, as you're saying, it's kind of like a one way or the other situation, and the market's really kind of the volatility is sort of shrinking and so forth. So it's hard for me to ask you to like predict what's going to happen. I don't think we can really do that. So, and that's not how either one of us handle the markets, honestly. So let me ask you this instead. I mean, from now, let's say from now to the end of the year, what do you think is the strategy or method or perhaps what are you looking at that you think is the best profit opportunity?
Yeah, I mean the strategy for me is I've moved out of my capital in equities for long-term investments. I'm just sitting heavy in cash, and I am more or less actively just trading between equities and bonds and in precious metals. I do own a very large portion of precious metals and mining funds with my long-term capital. As a shorter-term trader, though, looking for this year, to me the play is to be an active trader. You're either, when the market is consolidating like it is now, the stock market, you want to either be in cash or potentially look at moving into precious metals or bonds. And I found there's a really good strategy between when the stock market starts to roll over. Usually if you move into bonds, you can see bonds move and grind their way higher, just like we saw in August. Stock market traded sideways in a huge range, really hard to trade unless you're a momentum or day trader. Yet bonds just continue to truck and truck on higher, up and up and up for that entire month. And so that's the play that I see now is you either move to cash and go into bonds, or you play the quick initial breakdown in the equities market and go back to cash. And so that's where I am. I'm just actively moving more or less between long equities and then potentially long bonds, and looking to get back into metals. We got out of metals right near the high. It's pulling back. I think metals are primed and ready for another run. The charts look good. The weekly chart looks strong. I think we could see a huge run up above 1700 for gold, but I'm not buying yet. I mean, the trend hasn't really reversed and started to trend back higher. We've been correcting for several weeks here, and so there's still some upside that has to happen before I'm interested to get long.
Yeah, it's pretty simple. Anyone can look at the gold chart or GDX, and I've drawn like a little triangle on it connecting the recent highs, and we haven't broken to the upside of that yet. So that's what I'm kind of looking for as a signal that we're going to at least go back up to the recent highs.
Yeah. And the recent highs are really significant. If you look at GDX, I mean, the recent highs we saw a few weeks ago is almost the same highs we saw in 2016. It is a major resistance area. When we break that level on GDX, that $32, I mean, we could see a really big run. That'll be the true breakout in gold miners. That's when you want to be in individual gold stocks. The ones with the highest cost to produce gold, they're the ones that are going to, rally the most. It's going to be a whole new kind of round 2 for gold miners, or round 3, depending on how long you've been trading, right? It's going to be huge, but we're not there yet. But it could happen, within a month or two, we could see that break. So you got to be aware of that.
Well, hopefully if you're not busy, we can do a follow-up interview in a month or two when maybe the market is moving in a more meaningful direction than it is at this week at least.
Yeah, sure.
And for everyone out there, I distribute this out on as a podcast on iTunes, Spreaker, and all kinds of networks. It also goes up on YouTube. But go to technicaltraders.com to check out Chris's website. And also on my website, we'll put the post up for this interview with a link below to his most recent article. Well, thanks for taking the time to talk to me and everyone else, and do this again soon, hopefully.
Yeah, thanks for having me on the show.